No, it's on. Test. Test. KC 12.7's on page 491. Does anybody see anything different between this question and the types of questions we were looking at before? Anything different about these facts? It's about the shares taken back.
There's more than one kind.
There's more than one kind of shares taken back. In all of the examples we've been doing, there have only been preferred shares taken back. So here's an example when there's two kinds. Let me say at the outset, I'd like you to do this question. I'm happy you're doing it, but in our questions on the final exam, I just need you to know what the rules are when we take back one class of shares, and that class will be preferred shares. But if we take back two classes of shares, the answer to this question, which I'd also like you to look at, and I won't take it up here in the interest of time, shows how to take the adjusted cost base and allocate it among everything. Here's what I mean. Non-depreciable capital asset originally cost 40. That's what we're going to elect at. We want to elect at 40 so that there's no gain on this capital asset that's now worth 160. So the adjusted cost base of the shares, we start with the $40,000 and we deduct $10,000 that has to go over to the debt. That leaves $30,000 in total. And if we only had preferred shares here, as all of our questions to date have been, we'd say that the adjusted cost base of the preferred shares is $30,000 and so is the PUC. But since we've got two classes of shares, there's a special way to allocate both the adjusted cost base and the PUC. For your interest only, I'll tell you what they are. The adjusted cost base first goes debt, and then preferred shares. So the preferred shares scoop up $20,000, and then the common shares $10,000. So there's an ordering: debt, preferred shares, common shares. The PUC is a little different. $10,000 got scooped up to the debt, same thing. But the remaining 30, which is the PUC of all shares, common and preferred, gets allocated by the fair market value of the commons and the preferreds. So the fair market value of the commons is 130. The fair market value of the preferreds is 20. And it's a straight proration to arrive at 4,000 for the preferreds and 26,000 for the common, a total of 30. And you can visit the solution for more detail. Again, this is more than I need you to know. I just need you to know what would happen if it was just preferred shares. And in that case, we take the elected value of 40 minus the debt of 10 equals our paid up capital and adjusted cost base for the preferreds of 30.
And the PUC of the preferred?
PUC and adjusted cost base, 30,000. The second item was about page 483, the example regarding the Section 85 rollover for cumulative eligible capital. Now, usually we choose our elected value based on our tax cost. So for example, if we were looking at land, we would choose an elected value based on our tax cost of land. Let's say our tax cost was $100,000. We would choose $100,000 for our elected value. In the case of cumulative eligible property and only cumulative eligible capital, CEC, we take our tax value and multiply it by 4/3. And the only reason for that is you may recall that our proceeds on CEC, we always take our proceeds and multiply it by 3/4 to get our proceeds for tax purposes. And that's what they did here. So they said, well, our tax value is $18,000. So that's our CEC value, which is analogous to UCC if it were depreciable property. So we take 18,000, multiply that by 4/3. So we elected 24,000. Now we have deemed proceeds of 24,000, because that's what the election does, it creates deemed proceeds. We multiply that by 3/4 to get $18,000, and deduct that against our CEC balance, which started out as 18, minus 18 equals 0. Oh, no negative balance, no harm done, excellent. And that's all there is to know about that. So unlike every other type of asset, once we know our tax value, our elected value is 4/3. That's our proceeds times 3/4 equals the same amount. Exactly 0 ending balance, no harm done, no recapture, nothing like that. Any question on that? Excellent question posted to the Chapter 13 bulletin board about the calculation of tax for a CCPC. Do we have to know all these lesser thans and all the rest of it? The answer is yes, and I'll explain why. Let's say, for example, I tell you that as a fact, active business income is $460,000, and charitable donations is $10,000. And let's say that's the only type of income in the company, so it's a pretty straightforward situation. So then sort of step one is figuring out, okay, well, taxes. So I start with 38% minus 10% is 28. And now I need to figure out what amount on which to calculate the small business deduction. What percentage is the small business deduction? 17%, right? And that's on active business income. Is 460 net income or taxable income?
Net income.
Active business income, or SIB income, is net income. We calculate that down to net income. Therefore, we want to calculate the 17% small business deduction, not times 460, that will give us too much. Our actual taxable income is only 450. That's all we're really entitled to in terms of small business deduction. So it's the lesser of active business income and taxable income. Now, if you don't have any stuff like this, then you're right, it's just net income. And if the question you get on the final exam doesn't talk about any deductions from taxable income, then just go with this times 17%. I'm okay with that. But if there's charitable deductions, donations, or capital loss carryovers and stuff like that, other things to deduct to arrive at taxable income, please do use the lesser of, or else you will be overstating the small business deduction. You don't want to do that. And it's the same thing with the calculation of
General rate reduction?
of the general rate reduction. So 13% on the lesser of. So for example, if it was a public company with $10 million of income and $1 million of charitable donations, we would only calculate the general rate reduction of what percent? Of 13% on the net of $9 million. So it's only all these rate reductions are only calculable on the lesser of taxable income and net income from that source. And the same thing with the 26 and 2/3%, well, 44 and 2/3% tax on SIB income.
You mean aggregate investment income?
Aggregate investment income. So again, if your aggregate investment income is X, and you have, for example, charitable donations, it's always calculated on the lesser of. And just to repeat finally, if you don't see any of this, then just go ahead and do this. But if you see something like that, for example, donations, losses carried over, you have to take the lesser of calculation.
But if we don't see that, are you planning to expect us to write down lesser of blah, 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 and then have them all be the same thing?
No.
Okay, so we only have to write down the lesser than if there's actually something to compare that's different.
That's right. Did everybody hear that? So if you, it's a different way of saying what I said earlier. If you don't see this, then don't do the lesser of calculation. If you see something like this, do the lesser of calculation. And as I said before, if you want, you can do it in this format in Chapter 13, or if it's easier for you to do it in a table format, that's okay with me as well. Part 4 tax, when refundable, when payable, all that kind of stuff. No surprise that some questions have arisen on that. That is a complicated thing. Let's talk about it. Why do we have Part 4 tax in the first place?
Because dividends aren't taxed in Part 1.
Because dividends aren't taxed in Part 1. And why aren't dividends taxed in Part 1?
Because dividends are a reduction from income.
Because there's a deduction for dividends, so they come into income, but then we take them out. And under what section do we take them out?
Net income to the taxable income.
Section 112. So they come into income as, well, income, and then we claim a deduction to arrive at taxable income, and that deduction's in section 112. So because they're not taxed in Part 1, government says, well, we still might like to tax them, maybe under different rules. Let's create a new part in Income Tax Act, Part 4. That's what they've done. So that's the why. Simple case. My company owns shares of public companies. It gets dividends, and my company pays Part 4 tax on the dividends. At what rate? 33 1/3%. And that's the simplest case. And what is it about the relationship between my company and the public company that says that I should pay tax, Part 4 tax? Yes?
You don't own
I don't own more than 10% of the votes in value, and therefore the two companies are not connected. And that's why I pay Part 4 tax. What if my company receives a dividend from a company that is connected? And if it is connected, why is it connected? What's the...
Oh, why, if you get a dividend from a company that's connected, you just have to pay.
Whoa, no.
Okay, so if it's connected.
Why is it connected? What's the definition of connected?
Right.
10%, more than 10% of the votes and value.
Right.
Because my company owns more than 10% of the votes and value of the company that is paying the dividend. And once we've established that it say is connected,
Then
how
you-
much?
You just pay your percentage of their Part 4 tax based on your ownership.
You just pay your percentage of the dividend refund that they got
Yeah.
based on your ownership. So, I'll be right back. So, my company owns 15% of this company. So we are connected, show of hands, or aren't connected? Connected? Excellent. That means that I might not have to, this company may not have to pay Part 4 tax. If not connected, Part 4 tax is automatic. But if connected, only pay Part 4 tax if this company got a dividend refund. This company, in fact, got a dividend refund of 5. So this company pays Part 4 tax of what times what? Of 5 times 15%. So it's this dividend refund times this percentage ownership. And what amount of Part 4 tax is that in dollars?
And didn't you say before that when I pay that dividend to me, when my company pays the dividend to me, I can also get that 0.75 back?
And why is that? So the proposal is that when this company, which got this 5, so it's got 5 in here. Pardon me, it's got what is 15 times 15%? It's got 2.25 in here. Minus 0.75 Part 4 tax. It's got 1.5 of sort of retained earnings. You okay with that?
So where did you get the 2.25 from?
2.25? Where'd that come from?
Dividend 15.
Oh, sorry, 15.
Times 15% of your ownership. Yeah.
So the question is, now we're going to pay a dividend from here to here, right? So we start with whatever retained earnings we've got. $1.50. And we say if I pay a dividend, we've got this 75 cents that we paid. That goes into our RDTOH account. Say at the beginning of the year it was 0. We paid Part 4 tax. Of 0.75. So our RDTOH is 0.75. And I still know I got to come back to you. I'm going to go out on a limb here and hope that I can get all this 0.75 back as a dividend refund. In which case, I'm going to pay a dividend of 2.25. You okay with that?
Sorry, when you said you hope you're gonna get the 0.75 back, what do you mean by that?
What I mean by that is I have to do a calculation. Because my dividend refund is actually only the maximum of my RDTOH account and this dividend times 33 1/3%. It's just a formula.
The lesser of
It's the lesser of. And how much is this?
75 cents.
Score. So now what's happened is I've paid out this entire 2.25 because I was anticipating a dividend refund of 75 cents, which I got because this lesser of thing worked out for me. And now the 2.25 is up here as dividend income that I as an individual need to gross up depending on whether it's eligible or not eligible. Is everybody okay before I go to the additional questions?
It's about that, it's just, if they paid tax and all they had left after that was 1.5, then I assume they can't pay the 2.25, so they can't get their full tax back, so.
Sorry, but they do have just 1.5 after paying the tax.
Yeah,
But the dividend refund that they're anticipating kicks them back up to 2.25. So that's how they can pay a 2.25 dividend.
are they gonna tell the bank that, or how do they get that extra cash?
They'll tell the bank that because they're actually entitled, if they have no other income, CRA actually gives them a refund of this 75 cents. So it actually is cash back. So they know it's safe, just as long as this lesser of calculation works out for them.
I actually found the answer, that makes sense.
I'm just wondering, is it always going to be like the full RDTOH is going to be 1/3 of the dividend? Is that going to be, they're always going to be like the same amount? Like the two
No.
limits?
No, but it's okay if you do this as a start. This is actually a circular calculation. But it's okay if you do what I'm suggesting at the start here. If for some reason the RDTOH was less and we were restricted, then we'd have to reduce the amount of dividend refund, which means we're not going to pay out the full 225. But in most cases what you'll find is there's enough RDTOH to get back this Part 4 tax that we paid. What other questions? So the dividend refund is the lesser of the RDTOH balance, and the actual dividend, taxable dividend, times 33 1/3%. What other kind of dividend is there?
Capital dividend.
Capital dividend. So here's a situation where we might get, the lesser of may not work out for us. Let's say we had a capital dividend account of 30 cents. We've got these such small numbers here. Therefore, our taxable dividend would be $2.25 less 30 is $1.95. $1.95 times 33% would be less than 75%. So we would not get back 75 cents, not 75%. We would not get back the full amount of RDTOH
This time around.
this time around. But hopefully the next time we pay a dividend, it would all be a taxable dividend and we would get it all back. So that's a circumstance where we may not get back all the RDTOH if our taxable dividend is less than the amount of dividend that we got from our subsidiary. So to answer your question, this 225 times 33%, this is taxable dividend times 33 1/3%.
An extension to that. Supposing we now have,
Louder, please.
if you now have, in addition to the dividend, if you now have the TAS, refundable TAS on seed investment, how do we handle it?
Wouldn't that just make our RDT balance bigger?
Yeah. So for example, if we had SIB income that year on top of this dividend, let's say we had interest income. And remember, it's not just SIB income, it's also the taxable portion of capital gains, therefore it's aggregate investment income. And what percentage of that? So for sake of discussion, if we had $100 of AII,
Isn't that 26 2/3? He's thinking of the special tax. You're
Oh, I'm
thinking of
sorry.
the RDTOH.
26 2/3.
You might want to fix that.
So the amount that goes into the RDTOH account would be $26.67. For what other total that is. Now, sometimes the textbook says last year's RDTOH account was this much. It'll give you some facts. It'll say in 2011, the end of year RDTOH was 50. And then it says there was a dividend refund of 20. What that means is this 20 is taken out of the 50 to get you 30. I hate that. When I tell you that the ending 2011 RDTOH was whatever, I'm going to tell you it was 30. And you won't have to do this messing around. This 30 will be 30 like that. So you don't have to worry about whether this is before or after last year's dividend refund. You can assume from me that when I give you 2011 number, that's the beginning 2012 number. It's already net of whatever dividend refunds got paid in 2011. Okay? But as you're doing questions in the textbook, if you run into this, you'll understand why might be a difference between what I'm teaching and what the textbook says. Still on chapter 13. There were no questions on grip, and I just want to take the temperature as to if everybody's okay on grip, or if you need, I got one of these, is that, so what's grip and why is that important?
Well, grip is used to determine how much of the dividend that you're paying is eligible. If you have enough, if the balance of your grip account is a certain amount, any dividend below that will be an eligible dividend up to and equal to the grip amount. Any amount above your grip amount is automatically a non-eligible dividend.
And only taxable dividends.
Taxable
A
dividends.
capital dividend is never paid out of grip, just taxable dividends.
And you calculate it by taking 72% of the active business income over $500,000.
So the actual amount that was subject to the rate
General
reduction.
rate.
Yeah. Okay. All right. Yes.
Can the company elect which kind of dividends are being paid out, whether they're capital dividends or taxable dividends?
Question is, can the company elect which type of dividends it's paying out, either capital or taxable? The answer is yes. It's up to the company to decide whether it wants to pay capital or taxable. Can you think of any reasons why it's good to pay out a capital dividend before a taxable dividend? Number one, the shareholders love it because it's tax-free. Number two, it's cumulative. Let's say, for example, that I have, my company has a December year end. It's never had a capital gain before, so it's got no CDA. In April, it has a whopping big capital gain, $2 million capital gain. What amount goes into the CDA account? $1 million. In July, it has a capital loss on something else, a $200,000 capital loss. What amount goes into the capital dividend account?
Minus 100.
Minus 100,000. If it pays a capital dividend in August, it has to pay a capital dividend based on gain minus loss. But if I had paid it in May, I'd be allowed to pay it based on just the gain. And then as a result of the July transaction, it would just go into a negative balance until next time. So not only do we want to pay out a capital dividend sometime that year, we actually prefer to pay it right after we incur our, enjoy our capital gain. So there's both a shareholder reason, no tax, and a corporate reason, pay it now before we get a loss. Who was first? Sorry. Anybody else first?
I was gonna say, would one reason also be that if they pay the taxable dividend later, then they can defer personal tax until it's paid?
Very true.
Can you explain what you just said?
Sure. What he said is it's actually a deferral, because you know that someday we're going to pay out that taxable dividend. It's just better that if, say, the shareholders need the money right now, let's pay it to them tax-free first if we can, hence the capital dividend. And they'll get a deferral of the tax on the taxable dividend until it actually gets paid sometime later. So it's not a permanent savings. You're right, it's a deferral, assuming that we're going to pay out that amount of retained earnings at some point. Yes? Sorry.
Didn't you say you were going to give the grip amount, or did I read that wrong?
Yeah, in most cases I'll either give you the grip amount or give you enough information for you to calculate it based on 72% of the general rate income base. Chapter 13.
Is a person?
Is a subset of chapter 18.
Is a yoke?
Because with chapter 18, we've got to do some tax calculating. And there's some other stuff like, okay, how do we set up the income or loss arising from the gain on sale of assets and that type of thing. So what I'd like to do is go to chapter 18, because any chapter 18 question will also involve doing chapter 13. Earlier today, I emailed a question, which hopefully you have. I do also have some photocopies, if anybody needs them, if anybody besides me needs them. This was written by Cindy. So you're seeing this for almost the first time, so you can pretend that you're writing the final exam. I'm going to ask you to share if you don't mind. You guys share? I have 4 extras. Here's my advice on how to start this. You've got an exam booklet. There's, I don't know, 20 or 30 pages, and I have unlimited other exam booklets for you. Don't feel you have to start this question at the top and go to the bottom. I would do the following if I were you. I'd say to myself, okay, it's one of these questions, sale of assets. What all do I have to do here? And on page 1, I would write whatever the first step will be. And on page 2, I would write whatever the next step will be. There's probably 5 or 6 steps. We'll go through them in a second. Because honestly, if you just start at the top and just sort of get into it, you'll lose yourself in the detail. The time will go by quickly, and you won't sort of see the big picture. You know what the first step is? I think, figure out how much the goodwill is. So, Cindy says it's actually given to you. That sort of assumes that it's going to be given to you in the final exam. Not.
Oh, okay, if I knew that, I would have taken it out.
How much is the goodwill? So that's the deal where we do some stuff, and I'll get back to in a second. What's step 2? Gain or loss on every type of asset we've got. Step 3, tax on every type of income that has arisen.
So shouldn't you really put step 2 as gain, loss, / income?
Sure. Once we figured out how much the tax is, plus any liabilities we have to pay back or that type of thing, we can figure out what type of dividend or distribution we're going to pay out. There are two choices, taxable or capital, or a combination of the two. And that will include the CDA calculation and RDTOH and that type of stuff. Now you say to yourself, okay, I know where I'm going. And now you can sort of attack it and even time budget yourself if you want, based on sort of what the larger steps are. And if you want to, you can even ignore what the requireds are. As long as throughout this process, you'll get them. So for example, if I say, what is a CDA account? Oh yeah, I did that here. If you want, do it by process like this. And give yourself a page or 2 pages or whatever you feel comfortable with. But start at the top of the trees before you get into the detail. In fact, if you would take that as advice for your professional life, I would be much obliged. You'd be surprised, or maybe you wouldn't, how many accountants, lawyers, financial planners get right into the sort of nuts and bolts of the calculation without really understanding sort of where they're going. And this is a way that you can figure out first where you're going, and then get into the detail for each one.
On the exam, like, say there was a capital gain on an asset, would you want us to separately state that that the other, like the non-taxable portion would go into the CDA, or can we just put sort of the number? Like, do you want an explanation written there?
If you put something like CDA, open parenthesis, non-taxable portion of something,
Yeah.
that would be fine.
Okay.
I want to know that you didn't just pick out a number out of the air.
Okay.
Like, oh yeah, I picked this number since it's a non-taxable portion because I had a capital gain of 200,000. And so. So, I'd like 2 volunteers, one of whom is Cindy, who will take up the answer with you. But if there's anybody who would like to start, with each of these, in fact, let's perhaps have a volunteer for this one and a volunteer for this one and so on.
And you can actually do the goodwill calculation because I ended up changing the purchase price because the purchase price and the capital, or sorry, the goodwill amount don't agree. So if you use my purchase price of $1 million, you should get a different amount of goodwill. So that'll be your test.
Excellent.
And then we'll change the purchase price to use 370 because that's what I've used in the rest of that's okay.
Okay.
So what's my role in this?
You're going to, I don't have the answers.
Oh, okay. You need a separate, I'm sorry, volunteer. Calculate
Yep.
goodwill?
Good.
You want-
So you're going to be the, let's call you the professor, and I'll be in the background just sort of telling everybody whether they got it right or not.
You mean whether I got it right or not?
So if we have a volunteer, or if someone would like to shout out where you think we would start, and I'll do the writing.
Oh, that works for me.
To calculate goodwill, we first want to look through the assets and see which ones were the good assets.
No.
Okay.
The fair market value of the assets.
Why not?
You don't need me here.
Stay there.
Well, I'm going back from that question that we did on the assignment.
But good assets and bad assets are for a different purpose. They're for the capital gain deduction, right?
Okay, yeah,
This is a sale of assets.
okay.
We might get back to you, depending on if there's a required, to say what would it be on a share sale.
Okay.
But right now, we're looking at an asset sale.
I have a suggestion.
Yes?
I would set up an equation of assets plus goodwill equals liabilities plus the purchase price.
So other assets plus goodwill, which by the way equals total assets, right? Equals purchase price, that's for the,
That's the 1 million, whatever they will pay for the, or equals shareholders' equity.
so is the $1 million being paid for the shares or the assets?
That'd be the assets.
It's good.
That's for the assets.
And where does it say that?
Halfway through the second paragraph.
Oh. Can I change one number for you, by the way, so that this actually balances? I don't know if you noticed, but the liabilities on here do not add up to 775. So the correction there is the loans payable is 120,000. Okay? That actually adds up to 7075, even though it doesn't look like it would.
Tell me about this equation. And let me also write underneath it, assets equals liabilities plus equity. So the $1 million is being received for what?
To be for the assets.
I think it's for the assets.
Yeah.
So then what would you do? I'm gonna take this out if you don't mind.
Yeah.
So $1 million is for the assets. And I presume that all of these assets are at fair market value, 50, 75, 70, et cetera, et cetera?
No, they're not.
Oh, land and buildings and equipment?
Yes.
Okay. So then what do I do to get to my goodwill value?
Isn't it just the difference between what you originally paid and what they're worth right now?
Well, it's the difference between $1 million and the fair market value of all the other assets. What's the fair market value of all the other assets?
What does the $1 million represent?
The offer, the purchase price.
For the assets.
Total fair
Oh, that's
market-
your equity,
The
yeah.
total fair market value of the asset?
Total fair market value of the assets.
1,030,000.
That's
Says,
correct, 1,030,000.
It has to be less though, doesn't it?
Well, that's why I changed the purchase price. When I gave this to Dan, I told him it was in flux, and that I needed to work on some of the numbers. So this price went up because of this very problem.
There's negative goodwill. There's negative.
happy now?
No, that's the actual fair market value of the assets.
Okay.
Oh, so you're saying then there'd be no goodwill?
What'd you get that?
Well, I want to make sure I've got the facts right. Here it says she's been offered $1 million for the assets.
Yeah.
And you're saying it's $1,030,000?
No, I'm saying the fair market value of all these assets, excluding the goodwill, 370. So this number would be.
Okay, the total asset value is $1,004,000.
Fair market value.
Fair market value. That's too many words. How do I calculate the goodwill from that? I want to calculate it. I don't care if it says it in here, I want to calculate it. How do we do that? So the total fair market value of the assets is $1,004,000. How do I get the fair market value of the goodwill? Subtract everything else, right? What's the fair market value of all the other assets? What numbers do I add or subtract to get to the total fair market value of all the other assets?
What's the purchase price? Sorry, purchase price is 1.4 million?
for all of the assets.
Okay, the total assets that are listed less goodwill is 1,030,000.
Yeah.
And what numbers do I add up to get that?
You add up the values given for cash, accounts receivable, and investments, and then add the fair market value for land, buildings, and equipment.
Okay, if you don't mind, I'll do that in shorthand. I'll take 775
Plus 70, plus 300, minus 115.
minus land of 80 plus land of 150 minus buildings of 300 plus buildings of 600 and minus 200 for equipment and plus 85 for equipment. And that adds up to $1,030,000.
Yep.
And therefore my goodwill is worth $1,004,000 minus $1,030,000, which is $370,000. So far, so good. Everybody okay with that?
So that one,
Is it-
Sorry?
so, that purchase price of 1,400, there's no way of calculating that, that would be given.
That is given.
Okay.
Yep. Next
Yeah, it's
question.
one or the other, right? Can't both be black boxes.
Don't you subtract liabilities to get goodwill? Or is this because they're just purchasing the assets you don't?
She wants us to pay, or the purchaser wants us to pay off the liabilities. Does that make a difference at all?
No. This is what's being asked for the assets. So we're taking, if you think of a balance sheet, we're taking our assets, getting rid of them, and substituting cash.
That's interesting, because when you did the goodwill calculation when they bought the shares, then you subtracted what you actually did was you added the liabilities and subtracted so you're saying this is a different calculation?
This is a different calculation because they're not buying the
They're not
equity.
taking over the liabilities.
Correct. So if they're buying assets, we don't need to even consider the liabilities to come up with this number. Gain or loss? So what's the gain or loss on cash?
0,
Receivables?
0,
Investments?
0.
This is too easy.
Well, sorry, that's
Land?
not you.
70.
Land? What kind of income?
Oh, did you hear that person say property?
No, I didn't.
What? No, I'm just saying, if there's questions, that's why he's here to answer them.
I'm sorry, property?
Say it again.
Question?
Nope, not anymore.
Buildings. So, on buildings, we might have capital gain and recapture, right? What's the capital gain?
300.
300, because we're told that this 300 is the historical cost. So, I'm going to put land here, 70, and building 300. Is there any recapture in building?
Yeah. 50,000.
Are you happy with 50? What kind of income is recapture? In fact, it's active business income. 50. Equipment.
Loss.
Oh, it's tricky.
Could make it all easy.
What kind of loss? What's the capital loss on depreciable property?
Nil.
0. So it's a terminal loss of how much?
40?
No, it's a terminal loss.
I'm thinking 55.
Yeah. Oh,
Being 140 UCC and fair
Yeah.
market value of 85.
That's active business income.
And that's active business income, or in this case, a loss therefrom. We done with the assets?
No.
What's left?
Goodwill?
Goodwill. And takes through that.
No. Goodwill is ECE. No?
Yeah, and how much is that?
Oh, that's, well, we had,
What's our tax value?
0.
0.
And, we said that it was, what we say it was? No, 300, this is, I'm just telling you what, it's 370, it's 75%. Don't give me that.
You're right, it is
75%
times.
times the,
Doing good.
times the 3, no,
Zero.
There are two times, times 75%.
yeah. And then we
Somebody else said the
yeah, someone's
number.
whispering 2/3, which sounds correct.
So first of all, the balance in our CEC account is 0 before this. And we're going to calculate the reduction to the CEC account. And it's 370 times 75% times 2/3. That would be about 185.
Yep.
Why is that again? Those two calculations?
There just are. There just are. It's just a rule. If you go back
Just remember
to,
it.
Okay.
yeah,
That's all I need to know.
that's, yeah, sorry. What kind of income is this?
That's it. No. No.
You guys fight it out, and
It is, it's active. I'm in no position to go first.
any other types of income or anything like that? I don't think so. I think we're done calculating types of income.
No, there is no, I don't know if any of you guys looked at the 18-2 supplement that Dan sent out, but in that one, oh, I'm sorry, Mary Sale of Assets. In Mary Sale of Assets, there's investment rental property, and that investment rental property had capital cost allowance deducted from it. You probably don't remember the case, but it had a UCC below its ACB, and the buildings were sold for more than that. So in that case, because it was a rental property, which makes it property income, that recapture, even though we had recapture here on the building, that's active business income. In that case, because it wasn't, it was property income, that recapture was SIB income. There is no case like that in this investment. These are shares that they're non-depreciable. Okay, just so you know the difference.
And I'm looking at the clock, so we're going to move on.
Sorry.
So now let's calculate some taxes here. So on capital gains, I got 70 and 300, which is a total of 370. And that's total capital gains, so the taxable capital gain is 1/2. So that's 185, right?
Mm-hmm.
And what tax rate do I apply to that? 44 2/3. And that works out to
82.6.
$82.6.
Yep.
The other type of income I have is active business income. How much is that?
One. Yeah.
Thinking 180.
Yep.
Now, the sale takes place on April 1st. The company's fiscal year end ended on March 31st. What's important about that? Why'd you pick those dates?
Because if you sell your assets on the first day or early in the year, then you haven't used up your small business deduction, and therefore the income that's under 500,000 is eligible for the small business deduction rate.
I'm okay with that. So we didn't have enough time to earn like $3 million of active business income. This happened the day after the year end, so ipso fatso, as Archie Bunker used to say, this is all eligible for the small business deduction. And the facts say that the corporate tax rate on business income below 500 is 15%.
Yep.
How much is that?
27.
You didn't use a calculator for that, did you?
I did, just for fun. I'm already on the hot seat here, but give me a break.
So now we figured out all the tax. The total tax is, or did we? Yeah, I think we did. So the total tax is 82.6 plus 27. How much is that?
Can I use a calculator?
No. That'd be 109.6.
Yes.
So then, as far as the dividends are concerned and stuff, so we started with $1 million cash, right, for the assets. Then we have to pay liabilities. How much is that?
145.
Didn't we start with 1.4 million?
Pardon me. It's in flux.
That it is.
How much is the liabilities?
145.
How do you get that?
City changed loan payable to 120.
120.
Oh, for crying out
25. Sorry, it didn't balance. 145.
Sorry, what did you change? Loans payable?
Yeah.
Loans payable were 120, now they're 150. So total liabilities is 25 plus,
No, they were 150. They are 120 to make your balance sheet balance.
thank you. And now the total liabilities is 120 plus 25 is 145. What else do we deduct?
Taxes.
Taxes.
Sorry, how'd you get 145?
We added the liabilities, the loans payable of 120,000 and the $20,000 accounts payable.
25.
25,000, sorry, not wearing my reading glasses. That adds up to you.
You okay?
Well, we say taxes, so.
We said taxes were 109.6. What else do we have to take off of here to get to our taxable dividend amount?
Tell us.
No, what are we not going to send out as eligible or non-eligible dividends? What other things are we going to return to our shareholder that they don't have to pay tax on? Or,
Capital.
okay, so paid up capital, we have how much? 10,000. And you also said pay, so 10,000? And you said capital dividends, right? Which we figured out, oh, we didn't figure out capital dividends.
It's the other half.
It's
of
the
capital.
other half.
Yeah, there.
It's the other half of what?
The-
Capital
uh,
gains. And-
Let's do that calculation.
Just went away.
It's the non-taxable portion of the capital gain and also the goodwill goes in, the other half of the goodwill goes in. Or not half.
The other half of the goodwill does go in there, so that's 185,000.
Stop.
Oh,
It says on page 2 that the capital dividend account balance is $26,000. So that's the beginning, right?
Yep.
I'm just saying.
Good thing somebody's on track.
So
Beginning balance.
that's the beginning, and then we're going to add the goodwill first.
Yep, we said 185,000 was goodwill, the other half.
185. I'm okay with that. Anybody else? And then what?
And then
Taxable portion of that.
taxable portion of capital gain, and how much is that?
The non-taxable portion. You erased that. Oh,
By coincidence, it's also 185, right? Everybody okay with that? So how much is the total capital dividend account?
396.
396. Going back to here, I'm going to erase some more if you don't mind.
so we can get that back without paying tax. It's not an eligible or a non-eligible dividend.
I think this is our taxable dividend. So it's the cash that we got in minus the liabilities we paid out, minus the tax we paid out, the company paid, minus our PUC, minus our capital dividend account, gives us
$739.
Yes.
400. Yeah, we're done with that. Well, I guess until we pay our capital dividend.
I think something's missing.
Yes.
RDTOH.
Yeah.
Oh, yeah.
How much is that?
We didn't calculate it.
Do we know what it was at the beginning?
Yep.
61.
786.
And how much was added to it this year?
Well, 26 2/3% of what?
What?
RDTOH.
26 2/3% of aggregate investment income. Essentially our taxable capital gain.
Yes. And we had no SIB income.
So 26 2/3% times 185 is?
49,339.
You need a calculator for that?
Yes, I do. And I'm proud of it.
Total of?
111, 125. Where are you getting that number? You're saying I can't add it? 61, 786. Any of you guys with a calculator are welcome to help. 111, 125. All right.
So if there was SIB income as well in this question, would we need to add it to the RDTOH?
Yes. Actually, it would have come into this calculation because it would have increased our aggregate investment income.
Oh, okay, so it would flow through.
It would flow through. Very good.
Yeah, this is in fact aggregate investment income, which doesn't happen in this example to have SIB in it. It's just taxable capital gains.
Are we going to be restricted in our dividend refund?
No,
Why not?
because a third of this number here is much, much, much more than this number here. So you don't,
Everybody see that? So the dividend refund is the lesser of 1/3 of our taxable dividend and the balance in the RDTOH account. So as long as our taxable dividend is at least 3 times this amount, like about $330,000, oh yeah, it's going to be like $700,000. So if we pay that much taxable dividend, no problem, we'll get this amount back as a dividend refund. So we get to add 111, 125, and our taxable dividend will be,
Ugh, did you do more than that?
I think that's 850, 525.
That's what my calculator got to. So now how do we know how much is eligible and how much is non-eligible? Did we calculate it?
Are there more questions like this in the textbook, or is this the only one?
This isn't from the textbook, I just made it
No,
up.
I know, that's not, I
Oh.
know, because in 18, we only have 2. Like, is
Yeah.
there any questions that weren't assigned that might be?
No, but there's Mary, the sale of assets
The
on the
supplement kinda
D2L
goes
and
through
the
this part.
supplement one. So there's 3 more than the ones in the textbook, I think. No, I guess one of those is from the textbook.
This amount is eligible. What amount is ineligible for a total of 80,000, 850, 525?
813, 938. So why didn't this number increase?
Because there was no income that was above there's no income taxed at the higher rate.
There's no active business income over 500,000, all we had was 180.
So now I can figure out my tax thereon. So we're given that the tax rate on eligible dividends is 28%. Pardon me. I got that backwards.
I think you need to get rid of this
Yeah.
column. $10,244. Or should I do this in my head? That can't be right. Oh, I guess it was, actually. It didn't look reasonable. 268, 599. Whoops. 268, 599.
Total tax?
278, 843.
Now here's something important, and it's got nothing to do with taxes. When we figure out how much she has in her pocket, we need to set aside certain of the tax information. Like, for example, her net income is not relevant to how much she actually has in after-tax proceeds. The after-tax proceeds are all the cash amounts. So the asset proceeds of $1.4 million, the liabilities,
Well, you might as well less her tax, because you got it right there.
no, I don't
Oh,
want to go
you
there.
don't want to go there, okay?
Corporate amounts, please. Liabilities again.
145,
Corporate tax.
1096,
Does that include getting back the dividend refund? How much is the dividend refund? 111.
125.
Anything else corporate-wise, cash transactions? I agree not. And minus her taxes, which is 278, 843. So like none of these numbers is taxable income or net income or anything. These are just cash transaction numbers. To get down to cash in her jeans of,
77,682.
in the requireds, that takes us down to 1, 2, 3, 4, 5, 6.
I should have added 6B, what is her tax payable on the proceeds, which is what we just did.
And number 7 is to determine the share price that she would get to get the same amount of after-tax amount of the sale for shares. Does she have capital dividend account available to her?
Yep. That's stated.
So then the formula for that, which we won't do, is the same one in chapter 18 on page 657, but working backwards to also include the capital gain exemption, not just her adjusted cost base. Did you do that in the solution, or will you?
Yes.
That calculation will be in the solution, which you'll get tomorrow sometime. Now, I want you to know how to do the math on page 657, but I will not throw into there the capital gain deduction. Just this relatively simple example where all you need to insert is her adjusted cost base.
Sorry, which map? There's 3.
On the bottom,
Oh, okay.
which is the working backwards calculation.
You're done with me, yes.
Thank you.
You're welcome.
Yes.
In your supplement questions, in the Excel, you had like a tax and a cash column. Is this what you're?
That's exactly what I'm doing here.
Okay.
Is I had a separate column because otherwise I'll get totally messed up. So I just have a separate column for tax stuff that I do on the side. Otherwise, if I do it based on tax numbers, I'll deduct an ACB or something crazy, and make a mistake as to how much gets in her pocket.
So can you write cash over the 1,400? Yeah.
So this is what that column would look like.
That's that cash column.
Yeah.
The tax
This
one
one is
was.
the level I did.
That number that we got there, was that, remember that?
Marlo, come and see me after, okay? Thank you very much.
Thank you.
Best wishes in your exam, with your career. All the best to you.